Hey you guys, it's Annie with Southtown Realty. I'm here for our third Thursdays, and tonight's person is Drake Bloebaum. I seriously hope that y'all come and watch because Drake is one of the smartest guys I know, one of the smartest guys in the business for sure. So let's see if we can get him. So fast. Nice work.
Right.
So this is Drake Bloebaum. He is a loan originator with Neo Home Loans. I've known him for probably 5 or 6 years now. And he and Neo and Truly Title just recently did a big presentation at Beer Hive Distillery that was phenomenal. It was set up for real estate agents, and I went, and it was put on by this guy, Josh Metal, and it was one of the best presentations I've seen in a really long time. And so, spoiler alert, Drake and I just kind of redid this presentation. We did it on a Zoom call, and we're going to be putting it out there to the entire internet in the next few days. I don't know how long it'll take. But tonight, I wanted to talk to him about like the general concepts around it. You guys can ask questions live, and then if anybody wants to go and watch that interview, I think it took about an hour, then they can do that later. So welcome, Drake. Thanks for being on my show.
Thanks. And it was fun chatting with you about the presentation earlier.
Yeah, you knocked it out of the park. I thought you did a really great job. Why don't you give us a little background on you? Like, how long have you been in the mortgage world? Where did you come from? Just give us a little background. And you do cool things. You ski and you do water rafting stuff. So give us a little background.
Okay. Yeah, I've been mortgage lender for, 18 years now. It's crazy. I started in November of 2005, right before the
What a
world
time.
about in the financial crash. It was a really interesting time to start. So yeah, I've been doing this for 18 years and really enjoying it. I came from the world of, outdoor stuff. I was a whitewater rafting guide for 8 years leading up to getting in the mortgage industry, which like totally polar opposites. But
Are they though?
what's that?
Are they
Are
different
they? No,
though?
I mean, you're leading people through dangerous situations, right?
You
Life-threatening
keep
situations.
nerves calm. If it's dangerous, you get them out of there. I as a mountain guide for 10 years, I have this big analogy about that, and I think rafting guiding would be the same thing. But continue.
And you have to be personable and know how to deal with people because you're out in the middle of the wilderness with them for 7 or 8 days in a row. So yeah, it was awesome, and I still free time love doing all of that outdoor stuff. So yeah, I've been doing mortgages for 18 years. I've been a top 1% of what I do in the country for probably about the last 10 years. And yeah, just love helping people not only just get into homes, but understand the benefits of real estate and financial literacy so that they can improve their lives and go do what matters more to them in their lives, right? Like, if you build assets and wealth, it allows you the freedom and the option to work rather than the necessity to work, right? So I want to teach people that so that they can learn to have passive income and go skiing and biking instead of being at work.
Yeah, this is the great thing about Drake, as I always go, he's a real human person, and that he's got the family, the outdoor pursuits, and then also is in mortgage and works really hard and is an incredible numbers person in regards to finance stuff. Like even just the other day, I'm always like, so should I like sell my house, or should I do this? Should I buy it this? Should I buy this? And he gives me all these great resources. So I think it's great. So why don't you give us like a brief overview, if it's possible, of the presentation I'm referring to? Like, what is it about? What's the hook?
Yeah. So essentially, a lot of people are scared right now in terms of thinking about real estate, right? Like um, it's a scary time because rates are higher than we've seen in the recent past, right? And it feels like a lot of people feel like news basically is telling people that bad time to buy a house. They're worried that housing market's going to crash, right? And so in the presentation, we go through all the data underlying the fundamentals of the real estate market and the mortgage market and inflation. And we show that there's essentially no chance of the real estate market crashing. And we go through point by point and walk through that.
Yeah, I think it's so great because I mean they have data going back to the 1940s of like what generally happens in real estate, what just happened and what's happening now. So I'd love if you talked a little bit about just maybe like the past 6 months, like what has, like I think in general, people know that during the COVID years, you know, interest rates were super low, the market was really crazy, there was like multiple offers, it was like this big thing. And I think that people kind of anticipate that when you have like this big thing that happens, there's got to be like a counter to that big thing happening. So what has happened since then in terms of rates and things like that from a mortgage perspective?
Yeah, so what happened is because during COVID, the Fed lowered interest rates, right? They did that to support the economy during a very rough time and stabilize asset prices and keep the economy full employment. That's part of their job. The problem is they overcooked it a little bit, right? Or a lot. And so when they overcooked it, they caused inflation. And when inflation went up, which is what we saw all of the second half of 22, right? Inflation went up. Because inflation went up, mortgage rates went way up. The beginning of 2022, rates were in the threes. The end of 2022, rates were in the sevens. So and then we talk about this in the presentation, that's the fastest increase in rates that we've ever seen. And so what that's done is it's just absolutely put the brakes on the housing market, which is good in a way because, you know, home prices were sort of starting to run away. We had several years of 20% appreciation, and that's just not healthy. Like nobody can afford that in the long term. So we've had these massive run-ups, and now the Fed has raised, because to fight inflation, the Fed has raised rates, and that has caused mortgage rates to go up in response. So that has slowed the demand for homes. So that's sort of the quick answer to what's happened in the past 6 months. So what I'm telling clients every day is that we're in a bit of a moment in the market where there's an opportunity. These high rates are creating an opportunity. Well, how can that be, right? Like a year ago, my $2,000 payment is now a $4,000 payment, right? That doesn't sound like an opportunity to me. But what the opportunity is in that is that because mortgage rates are higher, the Fed didn't raise mortgage rates, and we'll talk about that more. Because rates are higher, that's pushing a lot of people out of the market, right? So when there's less competition, that means the folks that are still left and still willing and able to jump in have less competition to deal with. And so you can attest to this, and please jump in, that over the wintertime, we were seeing clients get price reductions, concessions, on their interest rates, things that haven't happened in a decade, right?
Yeah.
And so there's this opportunity that the people that were brave enough to see through and make offers got better deals than they've been able to get, or maybe even got in when they wouldn't have been able to get in 20 and 21, right? Like a lot of first-time homebuyers couldn't find a house back in 2021 because they were competing against cash offers, and sellers weren't going to take offers from 3% down and FHA loans and things like that when they had 3 cash offers on the table. Right?
Or people that just generally had, maybe somebody had just sold their house. We talk in this presentation about how much equity is sitting in homes. Like people are just sitting on these lump sums. So that guy sells his house. He's got $200,000 of, like, I'm going to call it funny money in his pocket. It's money that just kind of materialized over the course of him living there for 10 years. So now he's putting an offer on a house, and an appraisal comes in low, he can pay that appraisal gap. Whereas a first-time home buyer, they've like saved up their money, and that's like real money, like that money that you like have worked for and you like put in your time card, that's real money, and they just didn't have the same amount of money to compete. So I loved last fall and winter. I keep using this like thing that I was able to like flex that negotiation muscle, because all of a sudden buyers had some like standing in the market. So it absolutely is an opportunity. And that has kind of filtered in through this year. And now, only now are buyers kind of starting to come around and coming back again, going, okay, I guess this is like the new normal. So, you know,
Yeah, people were waiting for the market to crash, right? They were
yeah,
saying, oh, these higher housing market's going to crash. And now we've been, what, 6 months of higher rates. And guess what? It hasn't crashed,
yeah,
right? I mean, sellers have had to come back down to earth and they've been knocked off their pedestals a little bit, right? They're not able to ask for as much as they were back in the pandemic, which is
yeah.
good. Um,
But they still have so
but,
much equity there.
and we've barely even seen a pullback, right?
Yeah, yeah.
Like prices overall really haven't gone down. Nationally, maybe they've gone down a couple of percent, but it's marginal.
I just ran the numbers the other day, and from January to today, we're up 7% already in Salt Lake. And again, I can't speak nationally. I don't know anything about Georgia or whatever. But yeah, in Salt Lake, we're up 7%. So this idea, Drake and I have been talking about this idea of like this vernacular that came from 2008 of people like, you know, subprime loans and crashes and bubbles and like all of these kind of hot words
Short,
that I think didn't. What's that?
short sales,
Short
foreclosures.
sales, yeah, all the things, these words that people didn't know before 2008, or I don't think they did, and really aren't relevant today. I feel like we should do a whole separate presentation on what does a housing crash mean? Like, what is a housing crash? You know, I was walking my dog the other day, and this woman in the neighborhood who's a little off kilter, but she saw me and she went, finally, my prayers have come true. The housing market has crashed. Finally, this has happened. And I was like, oh, sorry, I didn't get the memo. I don't know what you're talking about. So anyway, that's a whole other topic.
So
So
uh,
I'm just thinking, let's talk a little bit about the relationship between inflation, because we all have felt inflation. That's like a visceral thing, right? Like you go to the gas pump, you go to the grocery store, and you're like, geez, I don't remember cheese costing this much. Like that's a real thing that people feel. So what's the relationship between inflation and interest rates? How are they correlated?
yeah, so the question we get asked on a daily basis is, right, like, oh, well, I heard the Fed raised interest rates today, so mortgage rates must be higher, right? Well, no, that's not what the Fed controls is the short-term interest rate. And so that's the rate on things like car loans, credit cards, home equity lines of credit, those sorts of things. Mortgages are controlled by what are called mortgage-backed securities, which are bonds that are traded on the open market, right? Like treasury bonds, you've heard of 10-year treasuries. So these mortgage bonds are they trade on every day on the open market, and based on their price, whether they go up or down, that's how mortgage rates move. And so the reason that they're related to inflation is that they're a fixed rate of return investment. So I give you a lump sum of money and you pay me a fixed agreed upon rate of return. The problem with bonds is if inflation goes up, so let's say I'm giving you a $100,000 loan at 5%, that's a $5,000 a year in interest. So I'm earning $5,000 a year on my money. But if the price of gas and eggs and whatever, mountain bikes goes up during that time, right, my $5,000 doesn't go as far, right? So it's a bad investment because I have a fixed rate of return. That's why inflation is so dangerous for folks on fixed incomes, right? Because it eats up all their income.
Mm-hmm.
That said, mortgage bonds, the arch enemy of mortgage bonds is inflation. So as inflation went up, that's why mortgage rates have gone up. Now, the Fed is raising the federal funds rate to fight inflation, right? And it's working. So what they've done is they've raised all these short-term interest rates to make people's credit cards more expensive, make them more reticent to buy cars, make them more reticent to buy. We've seen, right? They want to slow down the economy to slow down inflation because that hurts everybody in the economy, and it's working. So because people are buying less stuff, they're not buying as many cars, they're not buying as many houses, we're starting to see inflation come down, and mortgage rates are following that trend.
Yeah.
Did I explain? Okay.
Yeah, I think so. You know, So Drake and I just did this interview today, and now we're doing this interview. And so I think both of our brains are kind of just like, there's so much information. I keep just picturing like this jar, and we're all like the little ants in the jar, and the feds are just kind of like trying to keep it regulated. They're not like trying to shake the jar up. They're like, oh man, COVID is happening in there. We need to like make sure inflation doesn't drop off. Like, let's give them money and like, let's lower interest rates. And then we all thrived and we're doing this thing and then we're thriving, 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 thriving. And then they go, oh my God, there's too much thriving. There's too much growth. Things are getting expensive. It's getting out of control. So then they put something else in there and like increase interest rates and, pull back. And I just keep picturing us as like this little jar of ants just trying to survive and them trying to like make sure we don't kill each other.
Not far off analogy, really. I mean, we're the ants. We like sugar. They gave us a bunch of sugar during COVID. We got
Yeah.
all hopped up, right? And excited. And then they said, oh, wait a minute, we better take this sugar away.
Yep.
Right? So that's what they've done right now. They're reducing demand, and that's slowing down the economy, which is lowering inflation, which is going to lower mortgage rates.
Yep. So what happens on May 10th? I'm springing this question on you.
Yeah. So on the 10th of each month, that's when the inflation numbers are reported. Okay. So every month, there's a new inflation print. It's called the Consumer Price Index. It gets published, and that month replaces the 12 months prior, right?
Mm-hmm.
And so had all this high inflation happening at the middle of 2022. That was sort of where it was really kind of starting to peak. And so what happens on May 10th is we replace last year's April high numbers, right? That's where we really start to replace some of these high numbers with new lower numbers. And as that happens, that brings the average 12 months down, okay?
Okay.
So on the 10th, we're going to start to see this inflation, this consumer price index number really come down. And when that happens, you're going to see the bond market improve, which means rates are going to improve.
Yeah. Yeah, I think that's such a cool date. Like in my head, May 10th has just been this like May 10th, May 10th. Come on, baby, come on. But what happens when interest rates go down in the housing market?
Good question. So what happens when interest rates go down is that housing becomes more affordable. Specifically, according to Black Knight, for every 1% that interest rates go down, 5 million more people nationally can afford to buy a home. So while that's good, we like homes being more affordable. The challenge is that we just don't have enough homes, right? Everybody remembers from 20 and 21 that, the reason there are more buyers with lots of money and not enough homes, so therefore supply and demand, the price of the homes went up. That problem has not been solved. In fact, it's almost was made worse by the pandemic because all of these folks we talk about this in detail and give statistics on this in the presentation, but all these folks have, I think it's 80% of people with mortgages have mortgage rates of less than 4%. And they also have average 58% equity in their homes. So these people that own homes right now are very comfortable and they're not motivated to move. So that's locked up the inventory, and it's going to make it harder for people that really want to buy. If you wait for rates to come down, you're going to have multiples more competition, and we're going to be heading back towards that 2021 paradigm where multiple offers, appraisal gaps, writing letters begging people and offering them a kidney to tell you their home, right?
Yeah.
So that's really the ultimate advice and takeaway is that the market's not going to crash. It's about to blow up.
Yeah. And this is what I've been like trying to scream from the rooftops. There was a period of time, and I think it was in the fall of 2021, where something happened. Interest rates were still really low, but there was just this little lull, this little like doldrums in the housing market. And I remember being like, well, this is weird. Seems like a pretty good. And I was getting people like a little bit of concessions and repairs and things like this. Just had a few clients that got these deals. And I remember being like, dang. And then it picked up again, like immediately after that. And I told clients about this and they went, why didn't you tell me? And that's how I feel, right? Because I never want to feel like a realtor where I'm like, hey, it's a great
Right.
time to buy right now. You should like, but that's how I'm feeling right now, where I'm like, no, 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 really. Like, I'm not just trying to be a realtor here. Like, I legitimately think this is a good time to buy because while there are some properties and they're on the rise getting multiple offers right now, there's also a lot of properties that aren't and that are sitting there. And people are anticipating, a little bit of closing costs or rate buy downs from the sellers. And on the same token, because we have such wildly low inventory right now, it's a great time to sell because if you have a great house and we price it right and we list it right and we have all the things, you can be one of those few that are getting multiple offers. And I'm just like, but on May 10th, when they meet, if all of these projections are correct and interest rates go down, and that's what people have been waiting for, like you said, for every point, 5 million people are out there and we are landlocked on each side by mountains and north south by lakes, and homeowners are keeping their low interest rates and all their equity, and I think it's going to be like a legit thing going on. um, so will you talk about a recession, because I feel like people, and we should probably wrap up fairly quickly, but I feel like recession is another one of those like hot topic words that people are like, are we in one? Is one coming? What happens when, and then what happens to the housing market when that happens? So maybe just like a little recession overview.
Yeah. Yeah. I think a lot of people have what's called recency bias, where the most recent recession that most of us remember is the Great Recession of 2008, right? So a lot of people, and especially like millennials that lived through that time, their parents might have been losing their houses during that time, right? Or going short selling houses, or just some pretty traumatic stuff going on. And so that's all they know of a recession,
Mm-hmm.
right? And unfortunately, that was a pretty brutal and deep recession, caused by bad underwriting of mortgages and, all kinds of funky tricks by Wall Street, basically. But that's not what all recessions are like, right? So we go through a chart in the presentation that shows that home prices actually um, historically go up in recessions. The reason is that during recessions, recessions are deflationary. And as we talked about, mortgage rates like deflation, not inflation. So as we have a recession, that means technically it means 2 consecutive quarters of negative GDP growth. So what it means really is the economy is receding. It's getting smaller, right? Deflating, like think of it like a balloon, right? It's deflating, it's getting smaller. That helps mortgage rates. And because that helps mortgage rates go lower, that makes housing more affordable. And when it's more affordable, more people can buy. So that's why as we're projecting that we're going into a recession. This is the most probably widely predicted recession upcoming that's ever been. And all these economic indicators are just screaming that we're headed for a recession, which is frankly what I think the Fed has acknowledged at this point, that there probably is going to be a recession the second half of this year.
Yeah. Yeah.
But it doesn't have to mean the housing crash, I think is what we are leading to,
And
right?
thing is, if you guys watch this presentation that we put together, there'll be like a link in bio in a couple days, but you can see that throughout the course of time there's been like lots of recessions, like a bunch of them, but none of them created like the whirlwind of like the graphs and charts going like this the way that 2008 did. And the reason that happened was because of so many just like predatory loan issues and subprime mortgages and all of this stuff. And so that was like sort of a one-off in the whole thing. Like, I don't think in general, from what I learned from this presentation, that a recession is like the end of the world, and certainly not in the housing market. Like, but again, I think that it's this trauma-induced, thing. We hear recession and we think, housing crash, the sky is falling.
Yeah,
So,
it's
yeah.
understandable.
Yeah. Well, I cannot stress enough that when this presentation comes out, you guys got to watch it. It doesn't seem like anybody has any questions. It's on the live feed. Do you have anything else you'd like to add to just kind of like wrap up this general topic? It's like such a in-depth topic. It's hard to talk about it briefly, but anything you want to add?
Yeah, I mean, I just think the point you made about you trying to not be like the salesy realtor, and saying it's a great time to buy, just always a great time to buy. But if you look at the history and these of the historical home prices, like for example, I bought my first property in 2005, November of 2005. You probably, if you're looking at the chart, could not find a worse time to buy a home,
Yeah.
right?
Yeah.
They like rang the bell the day I bought that property. Like, all right, this is the top. We're going down from here.
Yeah.
But if you buy and wait, it works out. That property has tripled in value since I bought it
Yeah.
before in 2005. So, what I would say to people is that if it's a good time for your personal economy um, to buy a home, then and you're going to be in it as a long term, and by that 5-ish years, um, don't be afraid if there's an opportunity right now that's not going to be as good in the future.
Yeah. And just to second that, like I was telling Drake earlier, that the same thing happened with me. I bought my first place in 2013. And at the time, it was a triplex also. At that time, it was like the most expensive triplex of all the ones that I looked at. And I just had this pit in my stomach, like, oh my God, I'm totally overpaying for this. I don't know what I'm doing. I didn't know anything. I wasn't a realtor at that time. I didn't know anything. And it's literally more than tripled in price since then. And I don't have a single client. I've helped, hundreds of people buy homes, and I don't have a single one that says, oh my God, I wish I hadn't bought when I did. And the opposite is true, like almost in this comical way, like in markets that we talked about as being like terrible, like 2020, everybody's like, oh my God, people were paying, there's 40 offers, and they were doing appraisal gaps and pulling their 401ks and doing all this crazy stuff. Those people come to me and they're like, oh, thank you so much. I'm so glad that I bought when I did. And I'm like, what? And the same thing happens in every single, like, I've now been involved in a bunch of different markets, not as long as you, but every single person's like, I'm so glad I bought when I did. And so the people today that are like vacillating on their decision making of like, should we or shouldn't we buy? I'm like, what I can guarantee you is that in 5 or 10 years, you'll come back to me and you'll say, we're so glad we bought when we did. Because that's just like how it has worked over the history of time, and all of the graphs and charts and numbers and data like show that in our presentation. So sorry, I kind of took over the end of your, what do you have to add? But well, thank you so much for all of your work today, and for joining me on this Instagram Live. And like I said several times now, you guys, you've got to watch this presentation that we put together. It takes about an hour, but it's like very worthwhile. And yeah, I appreciate everything you do and contribute to my world and all my clients' worlds, Drake.
My pleasure. Have a great evening.
You too. Thanks.
Yeah.